Hello and welcome to SwitzerTV. I'm Peter Switzer. Thanks for joining me. On tonight's program, we catch up with Adam Dawes of Shaw & Partners. And I ask him about the stock he likes best of all for 2023. I get him to assess controversial companies Megaport and Tyro, and also does he like the banks and the retail sector going forward. And then we talk to AMP's chief economist, Shane Oliver, and he's known as an economist, but he's also a major contributor to AMP's investment strategy team. And I want to know what he's thinking about the stock market both here and abroad for 2023. What do you think about tech stocks, and what other sectors does he think will really do well in 2023? And that's the show. Let's kick off now with Adam Dawes. Well, my first guest tonight is Adam Dawes of Shaw & Partners. And there are a number of stocks, interesting stocks, that I wanted to get his handle on, and also what he thinks might be the best stock for 2023. Adam, thanks for joining us.
It's great to be here, Peter. Happy New Year.
Let's start off with probably the one that a lot of people love to hear you give some views on, namely the stock that you think is the best for 2023.
The best stock for 2023, I'm going to stay with my call from late last year and say copper. And any real exposure to copper is probably the best thing on our market now. Now that Oz Minerals has left, well, it will leave to go to BHP. We think Sandfire is probably one of the best stocks that you could put in the portfolio for 2023. Now, the stock has certainly rallied a fair bit on the back of this whole copper shortage of copper and what's going to happen on a global shortage. But I still think there's room to move with Sandfire. They've got a mine in Botswana, they've got a mine in Spain. I think Sandfire, it's going to naturally attract a lot of that capital that was going to Oz Minerals is now going to flow into Sandfire. So staying with battery metals, staying with that green theme, and a little bit further down the supply chain, Sandfire, SFR, is my stock code or best pick for 2023.
Yeah, and if you believe that the China reopening will be better for world economic growth 2023, 2024, you expect the demand for copper to be on the rise as well. So there's a lot of themes that support you there too.
Yeah, and I think you need those macro themes, those tailwinds, to start continuing to push through, because they're the ones that are going to give that excess firepower to any kind of stock. Yeah. So yeah, really comfortable with Sandfire. It does have a couple of warts on it, so you just got to be a little bit careful. It's not probably the number one pick. If Oz Minerals was there, or BHP, I guess, is a pseudo copper exposure. Yeah. But I think Sandfire is probably one of those ones that will continue to do well going into 2023.
Okay, let's go to a company that's had a bad report last week. It's been a darling of the tech stocks, and I noticed that every time US techs took off, like Amazon or Facebook, the one they bought here was Megaport, MP1, but it didn't report as well as expected last week. What's the house view on Megaport?
Yeah, we don't cover it here at Shaw's, but I knew I was talking about this one, and we've got clients in it as well. It's really to have a deep sort of dive into how or why this has now come unstuck again. Every time they report over the sort of the last 2 or 3 quarters, we've had this sort of negative push on the stock. And then it generally starts to get bid up again and then starts to move higher. But really, at the end of the day, Megaport is really disappointing. They added around about 762 new services over the 3 months through to December. But then they actually reported, and that was a lot lower than analysts' expectations. Most analysts were expecting a 20% higher number on that. So that has really knocked the sales or knocked the wind out of Megaport. I really do like the story. I think it's fantastic, putting people to the cloud, getting those ports opened up, and they can do it far, far faster than the Telstras of the world or any other sort of communication side of things. So they really do have that there, but it's really all about those numbers, and those numbers were 20% lower. And guess what? The share price fell by about 20% also on the day. Started to recover a little bit at the moment. So I guess if you're a brave tech buyer, you would be looking to buy some of this stuff down here, because NASDAQ has started to really come back, and a lot of the tech stories, albeit they're putting people off, they're reporting some lower numbers. Even all the US, Google, Microsoft, they've all started to rally. Apple, they're all started to rally. So potentially we might see the bottom, but Megaport continues to disappoint the market. So be careful when you're looking at this one.
Yeah.
But I think it's certainly a very good business, and I don't mind it down here at these levels.
Yeah. I wrote about it today in the Switzer report, and I basically concluded it's a decent punt, but it's still a punt. But I do think a lot of tech stocks, and I like your view on this, I think there's going to be some time in 2023 when interest rates rises in the US are definitely over. And I think there will be a real reloving of tech stocks, probably starting with the quality ones first and then the other ones. And I think our tech companies will benefit when that reloving starts in the US.
I definitely agree with you. And all the big names, as I said, are starting to move higher, albeit reporting some softer numbers. They are starting to move higher. And the market's always forward-looking, 6 to 12 months. They can see that interest rates aren't going to be rising forever. Interest rates certainly have killed that market, or killed it. Tech stocks don't like high or raising interest rates. But yeah, certainly our 1.0's actually started to come back a little bit.
Yeah, 6% last week, I think.
Yeah, so it's starting to, there's some green shoots, little green shoots starting to appear where it was pretty much a desert for a long time. So I think that's positive for the sector, positive for the story. But yes, it will definitely be driven by the US, and that's probably where it'll start first, and then we'll move forward into Australia.
Okay, let's go to Tyro now. They often say it's a payments company, but it's nothing really like Afterpay or Zip. It really is a competitor for MasterCard and banks and Visa and whatever. And there's a takeover move. The belief is that the board's being put under pressure to accept something around $1.80 or something like that, but they haven't got a $1.80 offer at this point in time. What does your company think of Tyro as a business?
Well, look, I think you definitely hold at the moment, because it does seem like there's a bit of a tussle going on for Tyro. And you're right, Potentia came in with a bid of $1.27. That got rejected. It came in with a bid of $1.60. That's been rejected. But the share price is around $1.70 at the moment. So it really does show that the market is potentially thinking there is another bid to come. But I'd also be a little bit cautious about Tyro here. There has been some, when you do a little bit of a dive into their sort of how their business works, and obviously it's a lot about transactions or tapping the card as you go through. But a lot of that, there's been talk about caution on discretionary spend and the exposure that Tyro has to that discretionary spend. Now, there's some numbers in the market at the moment that's saying that 80% of the transactions via Tyro come from hospitality and retail. So it does seem that there is a bit of that discretionary spend when they're doing the tapping. Obviously, Woolworths and you got your staples and things like that. But if that discretionary spend with higher interest rates does start to slow down a little bit, that potentially might put a little bit of pressure on Tyro at the moment. But as it sits right now, the stock's at $1.70. That means that the market thinks there's going to be a higher bid. If Potentia can come in and sort of take this out with $1.80 or plus, I think all shareholders will be happy, except for those ones that bought it at sort of higher prices. But it's been a good trade over the last sort of 3 to 6 months. Yeah,
it certainly has. All right, let's go to the banks. The banks were sort of perceived to be going to struggle, but as soon as that bad inflation number came out and the expectation of higher interest rates, banks are popular again.
They are, aren't they? You just can't keep a good stock down. And certainly Commonwealth Bank touching $110 or all-time highs the other day. I think Macquarie's the one that probably looks really good here at sort of $180. I think that looks fantastic at these levels. I'd be really comfortable with that. But certainly the others being ANZ, Westpac and NAB, look, they are struggling a little bit. Is it a great investment? Well, there's a lot of talk that banks will, they'll only ever make money. But they will continue to struggle, and I think this big mortgage cliff that everyone's talking about coming up in June or July this year, and I think that is going to be a bit of a test for the banks and how they're going to refinance those loans to better numbers and things like that. But overall, the banks are okay. My number one pick is Macquarie, because I think that they can make money in a down market as well as an up market. And then potentially I'll be looking at something like a NAB, I think would be another one. NAB's taken a fair bit of home loan market share of some of the incumbents. And I think that that's something that I'd be really keen to keep an eye on, is that NAB. So yeah, number one, Macquarie, number two, NAB, and I probably think CBA, albeit the best bank in Australia, at 110, I wouldn't be putting fresh capital in up here on that one.
Okay, one final one. Because of the interest rate stories or whatever, retailers have had a loss of supporters. As a sector, do you think there's potential or not? And if you say not, what is is there a retailer that you still like, despite the fact that you're not a great fan of the sector?
Well, it's interesting that, we raised this today because Nick Scali came out today. And I don't know if you saw it, but Nick Scali, the stock's down about 20% today. They didn't really, they missed, obviously, and that's why, but it was really about their outlook comments, because December and January were absolute crackers for discretionary spend, right? Absolute crackers. Everybody was worrying, or is going to worry about the home loan and all that kind of stuff, or higher interest rates, later on. And so January and December were very, very good months. But Nick Scali today said that if they don't have a good February, it's going to drag them down for the rest of the next quarter. And so I think that's pretty relevant for a lot of the discretionary, or the retail discretionary side of things. Whereas JB Hi-Fi has come off a little bit, albeit being very strong. Harvey Norman also has done that. And I just think that overall arching is that there's not going to be as much money in the back pocket of most people, and they're going to have to find somewhere, and they've got to pay their mortgage. And so that discretionary spend does come back. So what do I like in the sector? I potentially like the consumer staples, Coles and Woolworths. If people aren't going to eat out, they're going to eat at home. And so that will keep that basket size moving quite nicely. But overall, I mean, if I was pushed to sort of say something in that discretionary space, it would have to be JB Hi-Fi. I think JB Hi-Fi is a very well-run business. They know exactly what they're doing. But I would wait to see some more weakness in those numbers coming through. And certainly retail sales numbers the other day and consumer confidence the other day wasn't that fantastic. So I'd be cautious. So yeah, Woolies and Coles for the staples, I think that's a better play. But if discretionary, JB Hi-Fi, I think, is probably the best run business. Or the other one is Premier Investments, and they've had a couple of upgrades as well. But I think that price is a little bit stretched there as well. So I'd wait for that. I'd wait for those retailers to come back a little bit before dipping your toe in. Yeah,
I love a quality company being beaten up by the market, and JB Hi-Fi is a quality company. Just wait a bit. Right, let's just wait a bit. Mate, thanks for joining us.
Thank you, and have a great afternoon.
Same to you. That's Adam Dawes of Shaw & Partners. And let me remind you, as of the end of this month, February, we roll the SwitzerTV program behind a paywall. And the only way you'll access it is by becoming a subscriber to the Switzer Report. Now that'll cost you $397 a year, or you can pay for it monthly. And you'll get 3 newsletters delivered to your inbox. You'll get access to our Boom Doom Zoom show, where you can actually call in and ask questions about any stock you're interested in. You get invited to all our events, and we often put on anywhere between 5 to 12 events a year, where we get experts in, which give you some great insights on investing. You'll have access to the website, and you'll have obviously the chance to see this program as well. So go to switzerreport.com.au if you want to become a subscriber, and I really hope you do. And now let's go to Shane Oliver of AMP. Thanks for joining us on the program, Shane.
My pleasure, Peter. Great to be here.
Yeah. Now the whole world, well, the Australian world, know you to be an economist, and you're always trotted out when people want to talk about interest rates and employment numbers and inflation and things like that. And I'm going to talk about that with you, of course. But I also want to position you for people who might not know that you make a contribution to AMP's investing in various markets, bond markets, stock markets, and whatever.
That's right. I do contribute to the asset allocation, or run some asset allocation indicators and process, and therefore contribute to multi-asset asset allocation decision. So the rubber hits the road in that sense. It's not just academic economics that we undertake at AMP. it does actually translate into portfolios or have an impact on those portfolios.
Yeah. Okay. So, what is your best guess on what's going to happen to stocks in 2023? Let's start in the US first and bring it back home to Australia.
Well, I think we're going to have a better year than we had last year. Last year was a very rough year, obviously, on the back of the surge in inflation, higher interest rates, war in Ukraine, and recession fears. But I think we're now starting to see more evidence that inflationary pressures are peaking. That should enable central banks to get off the brakes or stop raising rates as much, and then later this year start cutting in some countries. And it should ultimately mean that if we do have a recession, it will be a mild one, and many countries, I think, including Australia, will be able to avoid a recession. Obviously, you still have those geopolitical issues out there, but I think they may not be as intense as they were last year. So I don't think it's going to be smooth sailing. We are going to have some bumps. We've just had a fantastic January. Shares in Australia and the US up over 6%. So we will have some rough patches. Volatility is still going to be a feature. Worries about recession will still figure in there, but I think by the time we get to the end of the year, the US share market will be higher than it started the year off. And that will translate or help the Australian share market do the same. But I think the Australian share market will be a relative outperformer, much as it was last year. And I think the broader underperformance we've seen in our share market since 2009 is in the process of reversing.
Yep. So Shane, is it too far out there then to say that 2023 could easily see our market, including income, so total return, getting around that 10% kind of return?
That's right. That is my expectation. You don't forget, you're getting a dividend yield on the market of 4.5%. You only need a bit of capital growth, and we've already seen a bit of capital growth there. In fact, the market's already up levels that I thought it might reach by the end of the year. To get a decent return, say around 10%. When you add in the franking credits, you'll probably do a little bit more than that. So I think it will turn out to be a decent year. It's interesting to note that there's been a bit of a pattern here. We had a good year in 2017, a bad year in 2018, a good year in 2019, a constrained year. It was a very volatile year in 2020. A good year in 2021, and then of course a bad year in 2022. If you continue that pattern, then this year should be a good year.
And it seems to me that, Shane, that 2024 should also be good. It's the fourth year of a US presidency. I think you've pointed out before, it's usually a pretty good year for the stock market. And also, a lot of the concerns of 2023 will be, in a sense, I guess, wiped out, where interest rates will be falling, and the stock market probably will be anticipating a better 2024. Would you be, at this point in time, I know it's hard to guess, but are you expecting a pretty reasonable year 2024?
Look, it should be okay. I mean, just put that political cycle in context. Last year was the midterm elections. Historically, the midterm elections in the US see below average returns. The last time we had a midterm election year was 2018, and that was also a bad year for shares. Top to bottom, the US share market had almost a 20% decline in that year, a bit worse in 2022. But the year after the midterm elections, the third year of the presidency, which of course we're now in, tends to be a good year, and 2024 election years also tend to be okay. So I think providing we don't slide into a hard landing and then inflation continues to come under control, which I think it will, then 2024 should be a reasonably good year as well. Probably not as strong as this year. This year is probably going to be better. But of course, there's political issues that will creep in next year with the US election. But still, reasonably good year. Okay.
And we've noticed that tech stocks have been re-loved over the last month. I think the Nasdaq was up over 12% for the month. You might have had that number better than I do, but it certainly has been a really, I call it a sneak preview of what might happen to tech stocks once we really believe interest rate rises are over and it's not going to be a serious recession. Is that a reasonable way of looking at it?
Look, it probably is. Tech stocks were amongst the worst losers last year. And obviously, if the environment turns around and inflationary pressures recede, interest rate pressures recede, that takes the pressure off tech, which I think we're starting to see. The only fly in the ointment, of course, is that tech companies benefited immensely from the pandemic and the lockdowns and everyone watching Netflix and whatever it was through that period. And we're not going back to that. So tech may not shoot the lights out to the same degree that it has in recent times. And you could argue that it's still, it's not so cheap that it's obvious that it's going to surge, but it's probably going to have a much better time than it has. I mean, my own bias would be towards more resources stocks, industrials, because I think one of the big themes this year will be a rebound in the Chinese economy, which I think in turn will help the Australian economy and share market. And therefore, I'm probably a little bit more confident in resources stocks than I am on tech stocks, but I take your basic point that less interest rate pressure is a positive for the tech space.
Yeah, and so those people out there who are a bit nervous about how well their BHP and Rio stocks have done, and the dividend's been fantastic as well, you're kind of implying that you might not want to get out too early in 2023.
Yeah, the danger could be in getting out too early and saying that it's unsustainable and things are going to be terrible. I think the risk is, we're going to have pullbacks. Yeah, they might have run ahead of themselves. We've got some earnings results coming up. We'll see what they do with their dividends. There's going to be occasional worries about China, but I think the broader picture will be positive for tech stocks, because if Chinese demand kicks in again, which it will, much like we had a reopening sort of mini boom there, China's going to have the same sort of thing, but a lot of that demand will show up in commodities like iron ore, not so much coal and gas. I mean, they obviously had a good run through last year, but I think in the resources space, it switches more to the miners and to some degree away from the energy space, although energy will still do reasonably well.
House prices, Shane?
Well, I think they've got more downside ahead of them. I'm not in the camp that says we're going to have a crash, because I don't see a recession in Australia. I see a slowdown in the economy. There's still the potential for more interest rate hikes. We'll see what the Reserve Bank does this week, but obviously there are risks on that front, even though I think we're getting pretty close to the top on rates. And also you've got the feed through of those rate hikes to impact borrowers and particularly people with fixed rate mortgages. So those things could still result in more downside. So we're in the camp that says a 15 to 20% top to bottom fall in property prices. We've done a big chunk of that, but we've got a little bit more to go. By the end of the year, I think as interest rate cuts from the Reserve Bank start to come into focus, then the property market will be able to start to bottom out, particularly probably around the September quarter sometime, and then start to rise again through the December quarter. But one of the big dynamics here is that over the last 30 years, interest rates peaked way back in 1989, probably when you were on the Doug Mulray show back then, and we're all early in our careers. Interest rates have come down from 17%, got down to lows around 2 or 3%. That enabled people to pay more for property because they could borrow more. That facilitated the big surge in house prices relative to people's incomes. Now we're probably in a world of somewhat higher interest rates than those very low rates we had through the pandemic years. We're not going back to where we were in 1989, but higher interest rates will probably or possibly constrain the upside in property prices as we go through next year relative to what we've normally had in the past. You'll get some sort of upswing, but I think in the absence of another new record low in interest rates, which I think is very, very unlikely, it's going to take a while before property prices get up to those record highs again.
Yep. And interest rates, what are you expecting from the RBA tomorrow, and how many more rate rises are you anticipating?
Well, I must admit the RBA is a difficult one. Personally, I think they should hold. I think they've done enough. I think there's enough evidence that things are slowing. There's some retail sales figures out today showing a fall in real terms. That means the volume of goods sold in the December quarter fell down 0.2%. They're only up 1.8% on a year ago. So the big boost to the volume of retail sales was a long time ago. It was a year ago. and now things have cooled down. That tells me that rate hikes are getting traction. And given signs globally that inflation's peaking, which as sure as light and day will flow through to Australia, then I should say, as sure as night follows day, it will flow through to Australia.
I wasn't going to correct you on that one.
Mixed my metaphors up there. Then I think that's going to lead to lower inflation pressures. So I think there is a strong case for the RBA to hold, but I'd have to say, seeing those inflation numbers that came out a couple of weeks back on the strong side, particularly the underlying inflation rate, that'll probably tip the RBA over into another hike this week, another 0.25%. But I think that will probably be the top. And we're going to get more evidence that inflationary pressures are cooling down as supply improves, as freight costs come down, as demand cools down, and that will enable then the RBA to go on hold. Just think about it. The average discount mortgage rate has gone from something like 3% to 6%. People say, well, who cares? Back in 1989 or 1990, it was 17%. 6% is nothing. Well, just think about it. The ratio of household debt to income today is 187%. Back in 1989, it was about 68%. So it's almost 3 times higher. Therefore, the impact on people's cash flows of a 17% interest rate back then is equivalent to a mortgage rate today of 6% or just a little bit less. So in that sense, we've already got to levels which caused a problem back in 1989. So that's why I think we're getting pretty close to the top on interest rates, if not already there. Maybe one more this week, but I think the Reserve Bank should be having a bit of a pause here.
Yeah, I think that's a very good point. One final one, because a lot of investors might be anticipating investing overseas. What do you think happens to the $1 across this year?
Well, I think it goes up, and it's already been on the rise. It had a low of 62 cents, I think around October last year from memory or thereabouts. And it's now about 69, 70, got as high as 71 last week before those payroll numbers came out. But I think it's probably got more upside to 75 cents. So when you're thinking about investing overseas, just bear in mind that a rising Aussie dollar will reduce the value of that investment. And therefore, you might consider investing in a hedged international equity vehicle if you can, or find some way to hedge against a rising $1, which will reduce the value of your international share returns. So that's something to be cautious of. But I think historically, when things improve, the US dollar goes down and the Aussie dollar goes up. Last year, it was the other way around. Everyone was nervous. The US dollar went up and the Aussie dollar went down, unfortunately. But that's hopefully starting to turn and will benefit the Aussie dollar.
Shane Oliver, thanks for joining us.
Thanks, Peter. Take care.
Yeah, same to you. That's Shane Oliver, Chief Economist at AMP. And that's the show for tonight. Thanks for joining us. Don't forget, if you want to be a subscriber to the Switzer Report, go to switzerreport.com.au. I'll see you next Monday.